Okay, hello everybody. Good afternoon. Today is October 8th. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the Premium Product Group Manager here at Investors Business Daily. Here is the disclaimer. Please take a moment to look at that. We will pull up stocks. We will talk about the market. We're not licensed here, so I can't make buy or sell recommendations or tell you investing strategies. We try to help you to fish on your own. Okay, so the market gauges, I've got the market in red. We're in a correction. IBD has the market in correction. The leadership, I toyed with going yellow or red. I think it just depends on what you're in, but the leadership is very sparse, or the leadership is in non-traditional can-slim growth areas. So, you could have some leading stocks. I have some stocks that I own that I think are acting pretty good. And there's some stocks I wish I owned that are acting pretty good, but it's not very broad at all, I'm sure. And then your portfolio, I'm not making a bunch of headway. I'm lightly invested, but in this environment, I'm just trying not to go backwards too much. If I can make a little bit, just survive for the next potential up leg, whenever that is. So let's look at the markets. Let's start with the NASDAQ, and this is delayed, of course. So this would be day one right there of a potential follow through day. I'm not going to count that as a pink rally day. You didn't close off the lows or anything like that. Closed in the bottom range. So forget about the pink rally day if you've heard that term. Let's just start with the very basics of a follow through day. Day one, day two, yesterday was day three. Pretty good day. Would not qualify because it's day three. Very, very rare to get a day three follow through, especially, barely off the highs. So I would definitely not count that as follow through day. And the good news is you don't even have to think about it because the volume was below average and even below the previous day. So today is day four. The market's down a little bit. So you're in a potential rally attempt. Ideally, it takes some time. That would be best. But again, I don't know what the market's going to do, and a lot of times it'll do just what it wants. In fact, all the time it'll do just what it wants. So I would prefer some kind of drawn out, longer correction process so you could get some bases. But I've wanted that here, and I've wanted it here, and I wanted it there, and I wanted it there. And so I have to be open to the fact that the market might just keep doing what it's been doing: short, quick, shallow corrections, and then back in a potential uptrend. This one feels different. I think, we've trained people to think that. So 1, 2, 3, 4, and this is just on the daily chart that's visible. It's kind of been the MO, and eventually that will stop. We actually had the first undercut of a low. We had an undercut of a low there, which you can see if you go back and look. Market very rarely undercuts a low. There's one there, but no undercut, no undercut, no undercut. So it's been very resilient. So it just takes time. I think time is going to be our ally here. The S&P, same thing, day four. Russell, just a big old base. I don't know what to make of the Russell. The only time I ever pull up the Russell is for these videos. Maybe I ought to just stop doing that. Emerging markets, if you want to do the follow through day concept, you're in day two. Not that great. Very, very, underperformer, down 13%. Off the highs. So not a lot going on in the overall markets. Let's go to the industry groups. So you've got coal as number one, and some of those stocks, I've just missed the whole coal bandwagon, and they've just made huge moves off the lows. It's just such a weird group, but you got to be, sometimes I think, gosh, be open to that group. But I don't know if I've ever owned any old coal stocks. It's been a long time if I ever have. Oil and gas, exploration, I can own stocks there and do finance consumer loans. UPST is probably the best stock in the market. You know, debate arguable with a few others, but definitely top 5, top 10. Retail department, transportation, shipping, which seems like it's starting to slow down a little bit, and oil and gas, Canadian, same group, just Canada, international. So you see the theme: oil and gas, and you know, oil went negative. Gosh, I can't remember how long ago, but for a brief moment, it actually went negative, maybe a year ago. And now you're staring at, I think it's $80 a barrel as we sit here. And one thing I've learned, and especially recently, is things happen fast and things go to extremes. So my imagination is, you know what, maybe oil goes to an extreme. And it went to an extreme negative, -30. Maybe it goes to an extreme to the upside, something, you know, that we would just can't fathom. 100, 150, 200, I don't know. I'm open to anything, but I do see that a lot in the markets lately. GameStop, I never would have believed could go up as much as it did. AMC, and then there's these UFOs all over the place, IRNT and ARQQ, and they just pop out of nowhere. So I am positioned in oil and gas with a couple of my biggest positions, or in fact, my 2 biggest positions are in that field. And you know, we'll see how it plays out. But right now, it's if you're going to be invested, it seems to be the best group. Okay, so let's go back to the slides. Got the markets. We did the industry groups. I've changed this slide to stocks to watch because, you know, rather than 3 stocks, I don't know why it has to be 3. I guess for the sake of brevity, I don't want to go on too long, but sometimes I might do 4 and sometimes I might do 1. So I decided we're just going to call it stocks to watch going forward. And I did mention UPST. It wasn't one of them, but I'll pull that up very quickly. Just super strong, no give back, way above the 50-day. You know, maybe this is building a high tide flag. I don't know. I don't know how I feel about high tide flags. It's been really, really tough for those in the last 10, 15 years. It's just not that great a pattern. But I am open to the strength in this name. And it just doesn't pull back. You know, it couldn't even pull back to the 50-day on the weakness in the market. So Ambarella is one that I do own. You have a really strong breakout. You get the power from pivot, pulls back to the 21-day, and that's where I bought it. I think it was Monday. In fact, I know it was Monday because I was on IBD Live. And it just seems to me, you know, look at the quarterly earnings and sales, super, super strong. And you're coming out of a really long base. Now, I wouldn't call this like a cup with handle. It's just, you know, it's just too big, you know, big monthly. But I remember AMBA here and participated in part of the move, never all of it. And it was a really great stock. So maybe this is part of the second leg up. Maybe their business is just hitting on all cylinders. The earnings and sales seem to say so, right? Negative, flat, huge triple-digit earnings growth. Let's open up the related information panel. You've got one fund in the IBD Mutual Fund Index. I don't think Ambarella is that big. Yeah, it's really a small company. So both good and bad. It's small that you don't quite have the sponsorship you prefer, but it actually is small, can grow, you know, with these trillion-dollar companies. I know they can go to 2 trillion, or 100 billion can go to 400 billion, but it's a lot. I don't know if it's a lot harder, but there's definitely economies of scale. So this is a name I own. Not really a proper buy point, honestly. I just kind of bought it because I have zero exposure to NASDAQ, can-slim type growth stocks, or I did on Monday. And I just was searching for one name that I felt like if the market gets going, I want to get some feedback from the market. So if I'm wrong, if it comes all the way back to the pivot somewhere in here, I'm wrong. I mean, if it's coming out of a really big base, it should keep going. So I really like the risk reward setup there. So, and then UPST was, that's one I probably, same kind of mindset. I considered that one, but I've been in UPST and it's a lot harder to hold. So that's kind of why I picked Ambarella. Devin, in the energy field, you've got your power from pivot. So if you want to follow that rule and you bought it out of the space, you're going to give it 8 weeks. And, it doesn't mean you stick your head in the sand. It just means that, as long as you're up, you try to give it room. Does that mean up, 15%? You might have some type of floor, 10%, 5%. I definitely wouldn't let it give it all back. But if you're going to try to capture a big win, got to give it a little bit of room to breathe. And that's what that power from pivot is telling you. APA broke out today out of this cup with handle. Here's an offshore driller that's acting really well. It's up 27% in 7 weeks coming out of this double bottom. The whole group is they're missing one name that I should be thinking of, but Denbury is not acting as well. I have tried that one and moved on. It's just got no oomph. It should go, right? It was so strong here and it just should go. So I don't own that one. I do have another one you'd think I would remember, but sometimes I get sidetracked thinking about other things. Let's go to Bill. This is another name in that can-slim growth area. You've got a pullback to the 10-week line. You've got a secondary. So you've got the secondary out of the way, which is kind of like getting the earnings out of the way. As long as it holds that secondary price. So this is another one that I would consider. If every day the market doesn't make a new low, I start to think maybe we're going to get some type of fall through day. So I would consider this one as well, and for a couple of reasons, mostly the sponsorship, really, really big. Gosh, 2, 4, 6, 8, 9. I have to admit, I bet that's the most you're going to find. It'd be cool if we had a little system for that. Unfortunately, we don't. But you're not just going to get that type of sponsorship in a name. So there's 9 of the IBD mutual funds have a position in this company. So that's another name that came across my radar. Okay, so the quote of the week is, and I've probably done a quote about diversification versus concentration before, but it seems to be the most common question I get when I do training sessions and when I go on the road and speak to people. Terry Smith wrote a book, Investing for Growth. He runs a fund in the UK, and says research suggests 90% diversification can be obtained in most markets with a portfolio of just over 20 stocks. So you don't need to have 100 stocks. You don't need 50. If you want to be totally diversified and you're going to own individual stocks, you can own 20, 22, 23, and you're fully diversified. The more you diversify, the less you know about each investment. It's really hard to know, 30 names. And also, it's, if you get one right, it just doesn't move the needle, which is the biggest problem, I think, with diversification. If you have a 1% position in Facebook and you take it up fourfold, that's an amazing move, but you move the needle on the whole portfolio 4%. So it's not going to make a difference. So you want to have enough that it moves the needle if you get it right. Not too much that you can't handle the volatility and do the right thing if the name needs to be reduced. So I don't know what the right number is for you, but if you're above 20, do some research. All of the research, white papers, academic papers, everything, even going back 20, 30 years, they've all kind of said the same thing. Here's a chart right from his book. It's the covariance of the FTSE, which is basically like the Dow in the UK. And covariance is the relationship of risk between 2 variables. So you know, 1-to-1 is, you know, 100 is, you've got 100%. So you can see as you go from 1 to 2 stocks, you know, you reduce your risk, and then 2 to 4, 4 to 8, but then it starts to flatten out. And at some point, it's basically just flat, and it's around, you know, mid-20s. You can see there's very little difference in the covariance of a portfolio with 25 stocks and one with 225. So if there's very little risk difference, if the risk of the 25 stock portfolio is only a tiny bit more, the upside of that 25 portfolio stock is a lot more versus the 225. So if you're out there and you just, you know, struggle with this, think about it, find a number that's right for you, do some research. Don't take my advice for it, you know, or, you know, I've seen this in a number of studies just from a simple Google search. Okay, that should do it. Contact information, reach us at marcusmith.com, 800-831-2525. Have a great day, everybody. We'll see you next week. Bye-bye.